Yeah, perfect. Over to you, please.
All right, so let's kick things off. We'll have more people join over the next couple of minutes, but it's good to start on time. So, hi everyone. My name is Saildrone. We're really excited to welcome you all to this fantastic discussion today. Quick housekeeping: we are here as one of the first sessions for the Pak Connect community to come together. Pak Connect is basically a community-driven initiative for Pakistanis from all over the world to come together, support each other personally, professionally. One of our principles is that feel free to use and leverage this community to support each other in any way that you feel fit. So that's one of the principles we are trying to promote. Today, I'm really, really excited and feel really lucky to have amongst us Bilal Zuberi. And for everyone who's kind of in the technology Silicon Valley scene, Bilal really needs no introduction, but I'll give an introduction anyway, because I know we have people joining from other areas of other industries. But Bilal is basically like a successful Silicon Valley entrepreneur who over the last decade has become one of the best known investors in Silicon Valley. He's invested in so many amazing companies which are now household names, and currently he's a partner at Lux Capital. He's also an avid tweeter, and everyone should follow Bilal on Twitter afterwards, because he's always giving a lot of really interesting insights, and I'm personally always really proud to see Bilal's successes as a fellow Pakistani. So thanks for joining us, Bilal. We're really excited to have you here. I'm also going to, before we jump into the conversation, I also want to make a couple of other introductions. Firstly, Minza, who will be hosting. Minza is also a technology entrepreneur based in Silicon Valley, and we are really excited that she's agreed to host this conversation. And then also wanting to hand over to Arzish Labs and Startup Grind to just quickly give a background on what they do as well, because they've been co-organizers of this effort. Umar or Ali, do you want to talk about Arzish briefly, or should we?
Thank you so much. Okay, so let me introduce Startup Grind. Startup Grind is the world's largest community for startups, founders, innovators, and creators. Currently, we have chapters more than 600 cities and 120 countries. So Startup Grind Pakistan has been very active since 4 years, and we organized Startup Grind Asia Conference back in 2019, which we organized for the very first time in Asia. So in which we invited, more 40% of the delegates was, from outside of the country. So that's all from my side. Ali Rahman, if you wanna say something about Startup Grind and your journey, so please go ahead. And then Said Rizvi, you can continue then.
Thank you, Umar, for giving me the floor. Assalamu alaikum. This is me, Ali Rahman Khan, social and tech entrepreneur from the Banu region, KPK. So I'm a chapter director of Banu chapter as Startup Grind. It is an international community for social change makers and professionals who are creating social and economic impact in different perspectives all around the world. So it have 160 chapters all around the world and almost in every countries around the world. Recently, Pakistan has organized an international conference with Startup Grind Pakistan Conference, where there were hundreds of industry leaders, entrepreneurs, investors. They were invited under a single platform where they were speaking about how we can create a social and economic change in our country, how we can support our ecosystem, how we can support our emerging
Ali, sorry to interrupt, but I think we have to move on because Bilal is waiting. So thanks for the introduction. Handing it over to Minza now.
Sure, no problem.
Conversation. Thank you.
Sure, thank you.
Thanks for all the interest, everyone. Bilal, again, really appreciate you being here today. Before we get started, I just want to remind everyone that we want to actually keep this informal and interactive. As Saad said, this is a community that's being built by the people who are in the community, so we want to make sure that everybody has a chance to be highlighted. the only thing that we want missing is the virtual chai from this session. So if you have if you have a chance, please rename yourself to your actual name. And then if you can turn on your video, that would be fantastic. We're going to start off with a few questions that we've compiled, but then we really want everybody else to participate and send their questions in through the chat. And as hosts, and even Bilal himself will look at the questions in the chat, and then we'll pick a few from the broader community as well. So let's kick things off. Bilal, why did you decide to transition to become a VC after being a successful founder? Let's start there.
Hey guys, first, thank you for inviting me. Great to see all of you here. I see some familiar names on this screen right now, so it's good to see that. I think it's great to hear that there's a lot of excitement about entrepreneurship and startups in the Pakistan community broadly, not just in the US, but obviously especially in Pakistan. These are pretty special times for many reasons. If you just think about what's happening in the world, most of the new job creation, most of the innovation is obviously coming from the startups. And it's happening around the world. And it's happening because startups and founders who build those startups are crazy enough to sort of imagine a world that doesn't exist today, and are willing to take some of the risks that other people would not take. Even somebody like me, I would argue, is more risk averse now than maybe I was 20 years ago. So founders really have, in some ways, a DNA of not caring about failure as much. And that allows them to pursue goals and targets that otherwise would be seen as outrageous. I tend to invest in areas and spaces that require that even more so than others. Let me tell you a little bit about Lux, so you have a little bit of context of that, and then we can talk about why I decided to become a VC. And this will be a very interactive, this is a very personal conversation. This is really about you getting to know that VCs are just like other people. There's nothing special about their DNA. There's nothing unique about them. They're not geniuses, or they're not ordained by anybody. My firm, Lux Capital, we manage about $2.5 billion. So about 8 of us who deploy that capital. We invest in early stage companies, but also late stage companies. Most of our money, when it goes into a company, goes in the form of, 100, 200K checks, sometimes $5, $10 million checks, which is, I would argue, is sort of the mainstay of what we do. And then we've written checks as large as 30, 40, $50 million at a time. When we invest in these companies, we obviously take a very important governance role. Usually, I'm sitting on the board of these companies and involved in pretty much every aspect of the company. The kinds of companies we invest in is really important because for those of you who understand venture capital would know, or even from the outside looking in, there are a few areas that really, have taken a lot of the venture capital money. They tend to be a specialist when investing in these areas. Way going back, many decades ago, Genentech was one of the first companies that was a major success for venture capital. And there's an entire practice around investing in that. Then you have enterprise companies, which are building, whether you call it classic enterprise software, Oracle is a big example of that. Then you had the cloud-enabled SaaSification of the world, and Salesforce is a big example of that. And today there's like hundreds of companies that are worth, billions of dollars. Then you have consumer companies, and obviously most of you at some point or the other probably use Facebook and Twitter and Pinterest and all of that stuff, and that's consumer startups. And then there's this area called deep tech, and deep tech sort of stands apart but also goes across all of this. And deep tech is solving hard problems. New semiconductor chips, new hardware software systems, rockets, satellites, drones, 3D printing, future of manufacturing, machine learning, AI, genomics. You go across the board and you have very hard problems that are technical hard problems, business hard problems to solve. And that starts to get classified as deep tech. And that's where I spend most of my time. When you think of countries like Pakistan, one could almost argue every problem is a very hard problem. Every simple thing that you will pick up to solve. There's no shortage of problems, by the way, anywhere in the world. If you and I just sat there for 10 minutes, we'd come up with 10 potentially billion-dollar ideas, I can guarantee you. It is not the idea that's the big deal. It is the execution of that. And I think when you're operating in an environment like Pakistan or India or Middle East or, you know, or Africa, the difficulties are that much more. And hence everything is hard. But that's the excitement. If it's hard, nobody else is doing that, which means if you're able to solve that problem, you're able to gather a lot of economic rent in that space. Now, getting back to the question that you asked. So grew up in Pakistan, came here to do my schooling, did my undergrad, did my PhD. You know, somewhere along, you know, my PhD journey, I had this realization that being successful myself just wasn't enough for me. I was doing my PhD at MIT. My PhD advisor was a Nobel laureate. In some ways, I saw that if I did everything perfectly and every star lined up for me, I'd probably become like him, you know. And what an amazing feat that would be for myself, for my family, for the country, for me to have like a Nobel Prize of some sort. But at a personal level, and this is where it really matters, at a personal level, when I imagined that world, it just didn't feel enough for me. And I don't mean that in some grand way. It just wasn't right for me. You know, in academia, you do some really important work, you break new grounds, you discover new things, you write seminal papers that are then cited for decades after you die. But it's felt to me like a selfish endeavor, despite me having tremendous respect for academics. I remembered myself growing up as in a middle-class family, lower middle-class family in Pakistan, growing up in Karachi, and realizing that I was one of the lucky guys who got a chance on a full scholarship to come to the US. There's nothing special about me. I knew people in my own class that were probably smarter than I was. They're probably, you know, more hustling than I was. They probably deserved to be in these conditions more than I am. So I had this feeling that there's this 180 million people, that was the population of Pakistan at that time, 180 million people that could have had this chance and the shot at it. And I got lucky that I had a chance to it. So I had to do something bigger than myself, and I didn't know what it was. And as I thought about it, it became clear to me that to do something big, you almost have to take a leadership role. You almost have to say, I'm just going to go do it. Nobody gives you the permission to do it. Nobody gives you, ordains you, go do something big. You have to do it yourself in any domain that you think about. It could be politics for all I care. For me, it became startups. I think I was, surrounded by people who were doing startups and cared about technology and cared about commercialization of that technology and using technology as a leverage means to change the world in which they lived and imagine a different future. I ended up becoming an entrepreneur, and I built that for 4 years and raised a bunch of money and then sold that company. And at the end of that, a bunch of VCs came calling, asking, hey, do you want to hang out with us and start something new? And I thought about it, and I realized that what I really like about that startup journey from, sort of an idea to finish was this early stage where there's a lot of unknowns, there's a lot of uncertainty. Your strategy is unclear, your team is unclear, certainly financing and your future and ability to pay rent is unclear. I think the technical word for that is sausage making. That sausage making stage, again, is not for everyone, but I felt I enjoyed it. And I thought, how can I do that again and again? Now, as an entrepreneur, you go through that sausage making phase. Well, then the entire reason to go through that is to be able to get to the other side and to build bigger companies and, not managing 2 people, but 20 and then 200 and, managing bigger and bigger revenues and clients and international clients and so on. And I realized that I can actually leverage where my strengths lie, where my passions lie, to be able to help these entrepreneurs at that stage early on, and VC allowed me to do that at some kind of a scale. That led me to being a VC. It was asked me to join them. We're large, doing well, had the capacity to experiment. Some of the lead partners are people I knew well, so the relationships were really important. And last but not the least, I wasn't joining a VC firm to sort of get a business card and become a VC. I knew what I was trying to get done. I still haven't achieved it. I still have work to do and a lot of work to do to achieve the goal. But the idea was to create an engine that gets that sausage making done better, so that the entrepreneurs who are going through this uncertain phases where there's a lot of unknowns and they will make mistakes are able to make mistakes that are their own, but they're not necessarily repeating mistakes that have already been made by others and that can be avoided. So that became my sort of, journey into the VC world. And it's been an exciting 12 years. These are dog years in VC. Most VCs you will meet have been doing this for 2, 3, 4, 5 years. The 12 years is pretty long. I've done it on both coasts. I was a VC in Boston and covered Boston, New York area for 5 years. And the last 7, 8 years, I've been in Silicon Valley. I've worked in 2 big firms. One is now managing, God knows, $8 billion or so. When I joined Lux Capital, we were managing about $150 million. We've grown that to about $2.5 billion. We're one of the larger firms now, and we have investments, about 130 companies in our portfolio. Most of them are US based. There's some companies that are based outside the US, and across every space you can imagine. Anyways, I'll shut up there and let you go on.
That's a great, it prompts a great follow-up question, Bilal, for me. How, we know that the due diligence process and then the support process, or as you're calling the sausage making process, is unique to each VC and startup and each individual investor. So it's almost like a twofold question. So can you talk a little bit about your due diligence process and evaluation criteria, and then the common pitfalls that you see in the companies that you've invested in, that you guide them through, and then how does that different between US based versus international companies?
All right, there's a lot of stuff in there, so let me try to parse it a little bit. There are 3 things you should know about a VC whenever you meet them. Okay, you don't need to know how successful they are. You don't need to know what yachts and mansions they live in. That's irrelevant stuff. Okay, there's only 3 things that matter. Number 1, what is the size of the fund that they're investing out of? Number 2, what is the stages that they tend to invest in more likely than not? And number 3, what are the kind of spaces that they tend to invest in? That sort of defines who we are. The first one defines what are the kind of returns we're looking for. So if I'm investing in out of $1 billion fund, and I want to be a top tier investor, I probably want to return 3 to 5x that amount of money that I've raised from LPs back to my LPs, right? So if I've raised $1 billion, let's assume I want to return $3 billion to them. Okay, in a single fund, you will probably end up investing in 20, 25 companies, okay? Let's assume that I get 20% ownership in all of them, right? You can do the math of what if I have to return $3 billion, these companies have to be worth $15 billion in my own portfolio. These 25 companies, somehow, some aggregate of them, have to be worth $15 billion for me to get $3 billion back so that I can return that to my LPs. Otherwise, I'm out of business, right? So you can do the math that, if you have 25 companies, some of them will just die. Some of them will be like, I return your money. You gave me $7 million and here's like $6.5 million back or $8 million back. The few companies that are going to actually click and work, they have to be worth billions of dollars for it to work. So when you see companies and when you see VCs and you have this exciting story that if you give me $2 million, I can make it 20 million for you. And it's a 10x return on your money. And it doesn't matter, right? It's not about a 10x return. The scale matters. Now, this is talking about a fund, obviously, that's $1 billion fund. Now, you do the same math, which is a $10 million fund, everything changes. You can just subtract out a whole bunch of zeros, and you can see why, an interesting idea that only requires $2 million to get going gets bought out by, imagine you have a startup in Boston, in Pakistan that's doing something around tailoring at home. And you started with $1 or $2 million, gets going, and then Kareem buys you for $25 million. But when you make you own still half the company, you made like $10 million. You're probably the richest person anybody in your family's ever known. And then $10 million back to that fund that gave you $1 million. They made 10x their money. In fact, if they were a $10 million fund, they have returned that entire fund, right? All the LPs have gotten their money back and everything else is on the house. So you have to understand the size of the fund that you're talking to and why you're talking to them. So people who come and pitch to me, it's very clear that either are you building, and is there a capacity in this company, in this market that you're going after to build a multi-billion-dollar company? And if yes, I'm looking at it as an investment. And if not, I'm here to advise, guide, and whatever, but it just won't fit the investment profile and investment criteria for me. So that's the size of the fund. The second thing is the stage at which you invest. So obviously that's obvious that there are people who invest when it's just an idea and a piece of paper and a team with a bunch of, glittery eyes that I'm going to change the world. And then other times there's metrics associated with the business. And then the spaces really matter as well, so that you're not pitching a, dark kitchen company to somebody who's investing in rockets. All right. With that in mind, if you have those things in mind, you can also understand what are the evaluation criteria that somebody would have when they're going in to invest. If I'm investing a $20 million check into your company at a $500 million valuation, because I think you could be worth 5, 10, $20 billion, you're the next Stripe, you're the next, Uber, or you're the next Amazon or Salesforce, I'm looking at metrics. I'm looking at real revenues and metrics and so on. But if you are, a professor coming out of a university with a very interesting idea and you're raising, $500,000 and I'm putting 100K into your company, it's a very different thing. I'm looking at you in your eyes and I look at your background and I say, is this guy capable of building something that could be worth something to somebody someday? Now, I put all this, in front of you to basically say every single company that you evaluate has to be diligenced, individually and very dependent on the particular circumstances. There are 5 things, if I had to do this McKinsey-ish, there's only 5 things that matter. The 5 things that really matter, I would say, number 1, the team. So I do a lot of diligence on the team, and, people will tell you all the time that it's, yeah, everybody says the team is really matters. The more you do what I do, the more you realize how important it is. We had a company that I'm on the board of that just decided to go public last week and just announced it publicly. I met this guy. I mean, I've known this guy for a long time. I met this guy at an airport where he presented to me this idea that he was going to do. I have to tell you, I had basically 45 minutes to decide to write a big check into this company, because I knew that if he walks out of that airport without agreeing with me that I'm going to allow to invest, there would be 5 other funds who would want to invest this company. So the diligence I did was all about me knowing this guy for sort of 15 years prior and his capacity to scale and build a big company. And you know what? I'm standing here to say, successful because, it's a multi-billion-dollar company now going public. That could have been a 0, could have been a complete failure, but the decision was made entirely on the basis of the team. So number 1 is really important in the team, which is this the right team? Is this a smart team? Is this a team that is right for the company that they're chasing, that they want to build? And does this team have the chemistry? The reason why a lot of people are having a hard time investing over Zoom is because I can't tell the chemistry. All of you are little boxes in a corner. I can't tell if you're a fun guy, if you are a sarcastic guy. When I ask a tough question, do you flinch or do you smile? Are you relaxed or are you tense? When good co-founders feel very comfortable interrupting each other. But if there's one big kahuna and everybody else is like hired engineers that don't interrupt the big guy speaking, all of those things are much harder to do on Zoom. But anyways, that's, minor issue that we're dealing with today. But the important thing is that all of those things that I just mentioned is what people are diligencing on the team. The second thing you look for is the product. Is there real technology here? Is there a real product here? Have they actually built something? VCs are not in the business of investing in business plan competitions. You can have a great idea and a beautiful slide, and 3 out of your 10 slides are how Pakistan has its growing middle class or young population, and I've seen that many times over. I'm not interested in that. I want to know, what is your product? What have you built? What data you have to prove that this product has some kind of a product market fit? And will you have a roadmap that, again, for me, looking for those big exits extends out over a period of time, that you have a vision for the space. I mean, Facebook went over the last few years from, the genius to like this evil guy. But put that aside, the genius of Mark Zuckerberg is that he was the first one to spot not only what he built with Facebook, He was a genius to figure out that I need to buy Instagram. He was a genius to figure out that I need to buy WhatsApp. There was no corp dev teams that were like, hey, Mark, you really should buy this company, this text messaging company that Indians and Pakistanis use a lot, right? That was not it. That was Mark figuring that out. That scalability of a product genius of connecting the world was the founders doing. The third thing you look for is TAM. Is the market large enough to sustain the kind of company you're trying to build? So if you're building a consumer company in Pakistan, I think it makes a lot of sense, right? Like you could build a pizza empire and be worth billions, let alone anything else. I mean, it's a very consumer society. Everything is right now, I need it, I want it, can I afford it? That's the decision-making process people go through. Everything from healthcare that they need to phones that they need and so on. That market can sustain that. But if you were building out a distributed databases company for Pakistani banks, well, I'm not entirely sure you can build $1 billion business there. Even though the largest enterprise company in the startup world that's not public is a distributed databases company, Snowflake, but may not be relevant for Pakistan itself. The fourth thing that you look for is what kind of capital this is going to require. So you may be coming up with a very interesting idea using technology that's available in Pakistan to create environmentally sustainable cement. Well, if you require hundreds of millions of dollars to put into the ground to make that a reality, is that capital going to be available? As somebody who's coming in with capital, I have to be, one of the things that you would depend on me if you were to take my money was that he or she is going to help me advise on the capital fundraising plan for this company. What will that look like? And I have to have a bird's eye view of, is that feasible and possible? So that becomes the next thing. And then the last is, if you build it, what will this be worth? Will somebody buy it? And if somebody buys it, what will they buy it for? What are the comps associated with that business? Today, if you look at SaaS businesses, they're valued at 35. They've all become very good at, it's a 30, 35x ARR multiple. And if none of this means anything to you, then, I apologize. But, if you have a, annual recurring revenue of, 10, this company should be worth, your Datadog, fast growing, you're 52x. It could be worth $520 million with the same revenue. But you know what? It's not too long ago when these multiples were 10x, right? So the same company doing the same thing just by the market, the way market perceives the quality of the revenue, either could be worth $100 million or less, or could be worth $500 million. You haven't done anything different in your business. You're still selling the same thing to the same customers, making the same revenue. But the market cap of your company has completely changed because of the comps that are associated. So that's a part of the diligence as well. Like, where is this going to go? Who's going to buy it? What's going to do? And I say this specifically relevant that when you're thinking about a country like Pakistan, and, I end up with a lot of conversations with people, why are there not enough startups in Pakistan, or why can't they scale and this and that? Part of the problem, Pakistan has amazing talent. There's no shortage of problems we talked about. So the TAM for the right kind of business can be very large. Teams can be very smart. Capital requirements in Pakistan are mostly lower than anywhere else. It's cheaper to build companies in Pakistan than it would be in Silicon Valley. So what is the problem? One of the big problems you run into is the lack of exits. Like, I am an investor. An investor is not a Seth that's going to own this business for 7 generations. I am not building this so my children can inherit this and their children can inherit. I'm a minority investor. I will own maybe 20% of your company. I'm here to take you through stages where I can be helpful and help you build. And at some point, you are a big enough company that I should get my money back so I can take that money and recycle and put it into other startups. If I can't find an exit, there's a big problem. And I think that's one of the things that, sort of on the agenda of Pakistani entrepreneurs. How do we change that? And of course, there have been some examples recently of some successes, but we need more of those.
Thank you so much, Bilal, for sharing that. We have quite a few questions that came out of like what you just explained and walked us through.
Are these the questions
I'm
looking at?
Yes, you
right
are
now?
looking at these questions. At the questions.
Okay.
This is, in the spirit of iteration, we are going to try this approach and probably refine this a little bit in later in our later in a later stage. But I wanted to just try it out and see if you wanted to pick a question specifically, kind of that really resonated with you.
I can answer any of these questions. Let me go quickly through them.
Yes.
I'm also looking at the chat box.
I'm compiled the questions from the chat box here. Yeah.
Okay, so let's see. How do VCs view? So number one, what do you value most when you're evaluating startup as a potential investment? The most important thing for me, as I mentioned, is team, followed by the team applicability to the market that they're addressing. If you talk to the entrepreneurs that we're funded, you will find, I think you will walk away saying these guys are wicked smart. And they are not just smart technically, but they have a perspective on the market that they're addressing that others don't have. One of the questions you should ask yourself when you're starting a company is, what do you know that gives you asymmetric advantage over everybody else in that industry? 5 young guys starting a company, it's not just knowledge about the market, it's also knowledge about the product or a particular angle. What is it that you're doing that would be so different than what everybody else is doing that would make you stand out and that would give you some sort of a competitive advantage that would be sustained? How do VCs view a single founder company with an offshore team? I think VCs have a pretty, across the board, and of course there are exceptions to the rule, single founder VCs are difficult. The single founder startups are difficult for many reasons. And if people are interested, I can talk about a few of them. One, there's existential risk, right? Like, what if you decide you're not interested in this anymore? You know, you thought you were super passionate about pizza in Pakistan should be high quality, and then you got diabetes and you're like, I don't even eat pizza, or I'm dairy free, and now what? Now I'm not interested in that anymore, so I'm going to hand it over to John and I'm going to go do something else. Well, here goes my investment. But I make a joke out of it, but you'd be surprised how often that happens. There's a reason why 20-year-olds, when they're in college, are all starting companies that are like sort of online tutoring startups and online collaboration startups. And then maybe late 20s, everybody's building a dating company. In the 30s, they build online productivity software. In the 40s, they build enterprise software. In the 50s, they build healthcare companies. There's a reason. There's the life that we're going through excites about certain things. Hey, a box full of, we start an online diaper company. It just won't happen. So that is a problem. But included in that is that the most important job that a founder does is that of being a salesperson. And that's not just to sell the product. They're selling, first and foremost, they're selling to their co-founders. Convincing somebody to join you on that journey that you are passionate about is a sales process. How many business people I see walking around, business school students and so on, I'm looking for a technical co-founder. And I'm like, that's your first big test. Come to me when you found a co-founder, right? Because if you cannot convince a single person to join you as a co-founder, how do you convince the rest of the world to take you seriously? So that's a big test that you have to pass to bring on a co-founder. The second is, you know, if you cannot manage a relationship between two people, how are you going to manage between 4 and then 40 and then 400? It's a test of management skills. You know, one of the things that you see a lot of VCs do, and I don't think it's used as a bias in any way, is that when you have, you know, when you see founders that have kids, they sort of have they have a certain stability in their life, not because of the kids, but because they realize, having dealt with kids, that you want them to do X, you know they're not going to do X. How do you then deal with it, right? So you are super smart, you work 20 hours a day, you freaking take a problem and run hard through walls, but everybody you hire is not going to do that. Either their personality is not that, they're not answering your emails at 12 a.m. Why would they do that? They have a life at home. They have to deal with things. Maybe they like sleep too. You don't, but they do. Maybe they have an ill parent to take care of. They certainly don't own 40, 50% of the company like you do. So why would they do this? How do you deal with that? That's, again, something you learn in co-founders. And last but not the least is you have to be able to understand how to get feedback that's critical from somebody else. The best role that founders play is sort of a yin-yang role. Founders are not necessarily supposed to be best buddies. If they are, that's great, but that's not the requirement. The requirement is a founder. What does the founder title mean? If you think about that a little bit, right? It doesn't mean that I'm the CEO, you're the CTO, we're co-founders. Founder title is that you are the life and blood of this company, even if you are no longer employed by that company, right? You can be, somebody can take away your CEO role, somebody can take away your CTO title or any title. What they cannot ever take away from you is the founder role. Right? That is the most important thing you will take with you with that company. So I think founders to be able to support each other when, you know, when I started my company as a co-founder, when things, even though we found it perfectly, every time he was going through a depression phase that this shit is not working, somehow I would be like, what are you talking about? Like, we can do this, we can do this, we can do that. And the other times when I was like, this tech is not working, I've tried everything. He'd be like, yeah, but maybe we can hire somebody to help, or maybe we can do consulting, maybe we can acquire IP. You gotta have this yin-yang role built into the co-founding relationship. All right, I'll move on because there's a lot of questions here. How much does a founder's prior experience matter when building a technology company in a different domain? Imagine somebody leaving Uber operation team to go build a fintech company. That is completely fine, as long as, again, going back to, do you have a point of view that is unique, differentiated, and validated in the market? It is completely fine for somebody, you know, I just invested in a company where somebody who worked on Uber operations, and he's now building software for programming PLCs. You know, I mean, in PLCs are this industrial equipment that's used in all machines. But he or she had a particular perspective on how he or she built DevOps tools for Uber drivers and what's relevant about that to apply to how DevOps is done for industrial machines. And I think there were similarities, but there were also lots of differences and lots of unknowns. So I don't think that's a problem. What you should understand is, when you come up with an interesting idea that you think is like, wow, I can't believe anybody thought about this. Like, how come? You should ask yourself the critical questions, like, why is it that nobody has thought about it? And if somebody else thought about the same idea, because once you come public with that idea, others will get the same idea. Are there other people that can run harder, faster than you? If you raise $500,000, what happens if somebody else raises $5 million and does the exact same thing? What will you do? I think that's real questions that you should ask yourself. And if the answer to that is, I am differentiated because of this, I can do something that nobody else can do, then you have something quite unique and quite interesting. I mean, Mudassir, founder of Careem, I just use that as an example of a Pakistani company that became worth billions of dollars, was one of my classmates from Karachi. I mean, we went to school together. And I remember talking to him when he was starting this company, and his, you know, and I was like, in some ways I was like skeptical. I was like, dude, you're building like Uber for Middle East. Like, I mean, come up with a more original idea, right? I mean, by that time there was an Uber for Denmark and an Uber for whatever, and Uber was buying all these companies for small dollars. And I told him, do you really want to build a company that Uber buys for 10, 20, $30 million? And he had a very unique perspective. And his perspective was, Uber is not going to go to these countries, Middle East, Pakistan, North Africa, for at least another decade. They're just not. It's too small, too broken, too many things that are just, they just don't work. You know, these countries' economy doesn't work. These countries' laws are not followed. I can make that work. I am from there. I can figure out how to put things together. And then if it comes down to fundraising prowess, well, it also turns out that I am able to raise, you know, I don't think he imagined he would be able to raise as much money as he did. He said, I can raise money to get this going. Unlike other two guys from Middle East who may say, let's go build a Careem, they wouldn't be able to do that. So he had a particular unique perspective on the industry and geography, and a particular capability that others simply did not have. Seems like nowadays, really hot startups are being chased by VCs, not vice versa. How do you differentiate yourself to founders? What's the pitch to go with Lux? Yes, indeed, there are many reasons why, at least in the US, I can't say that for anybody anywhere else, this is a seller's market. There's a lot of money that VCs have raised that's chasing few companies. It is a tale of two cities, in my opinion. You will hear a lot of VCs say that. Companies that are unable to raise are really unable to raise. And companies that become investors' darling then raise money every 6 months, it seems. And the reason for that is that all of us and I don't mean just as VCs, but all of us, even on this call, are going through in this crazy COVID time, going through a flight to quality. There are people who are saying, hey, I'm not going to leave my Facebook, Google job right now because I've got healthcare, I've got a good salary, I've got a good life. Like, this is maybe not the right time to do this. There's a lot of people doing that. Now, I can argue a whole bunch of people are thinking the exact opposite, but there's a lot of people who are thinking that. Same thing is happening with investors, that, hey, if you're already worth $200 million, then the chances of you becoming worth $500, $600 million are higher than if you're still at the $10, $20 million stage and trying to figure out if there's a product or not. So if you found some kind of a product market fit, people are obviously very attracted to you, and increasingly so. How do I sell myself? Gosh, that's a very long answer, but I would simply say, at the end of the day, smart entrepreneurs, and almost every company I look at will have multiple VCs wanting to invest in them, and all dollars are green. So I cannot differentiate that I can bring more dollars or less dollars than anybody else, or my dollars look prettier than anybody else. It comes down to the relationships. It comes down to what do I bring to the table. People spend a lot of time, everything from personal to professional. What have I done in the past? They talk to entrepreneurs to understand, what have I been able to do when there were two guys and a dog and didn't know what was going on, or didn't know when things were working and who to turn to. Proverbially, was I the call that they made? Or was I somebody that looked at as a boss that, hey, maybe we should like tone down what we say to Bilal? All the way to companies when they're going public, and what kind of relationship will I have with them at that stage, and what do I bring to the table at that point? So people look at that. But then they also look at, who am I dealing with? Life is too short. You don't want to deal with assholes. You don't want to deal with people that you don't trust. You don't want to deal with people that you don't know what they're all about. My life in some ways is pretty open. I mean, like, if you guys follow me on Twitter, you would probably even know the names of my wife and kids. You kind of know what car I drive. You know what food I like. Now, the reason for doing that is not some marketing gimmick. I've been like that since I was in school. Like, I'm just a very open, what you see is what you get kind of a guy. Not everybody's like that. I don't think everybody needs to be like that. There are people who have a lot more private lives. They go out of their way to not be on Facebook or Twitter or whatever. That's okay. That's fine with them. They do other ways of getting people to understand who they really are. But for me, it is I wear who I am on my sleeve. My politics, how I think about valuations, how I think about challenges that CEOs face. And hence, there's a certain amount of transparency that entrepreneurs get, that I know what I'm getting. And the devil is sometimes better than the devil you don't. When should an entrepreneur say no to VCs or angel investors, and how do you manage when certain VCs and investors are trying to take major ownership of the company in the name of investments? I think there are two questions here. First question is, when should you not take money? I think VC or, look, angel investors are investing in you. If an angel investor at the angel stage, now angel investors are right now writing $100 million checks. That's a different issue. But angel investor putting a small amount of money in you, just getting started with an idea so you can pay yourself the summer salary to get going, they're investing in you. If they're asking you a lot of questions about your go-to-market and product and technology, they're not an angel investor. They're starting to become more professional, even if they're an individual. Angel investors should be investing in you because I want you to succeed. When I write an angel check, and I do small angel investments sometimes, not in areas that I would do VC investments in, I write that check and I immediately write it off. Like, I don't anticipate getting anything back in that, because I want people to succeed. And that's my angel investment. And if it makes money, great. And I think most successful angel investors will tell you that that's how they view this. Now, VC money is professional money. You should raise VC money if you need to, if you're ready to. These are professional investors who are looking for their money back at some point. The clock starts ticking. When you take VC money, the clock starts ticking. For me and for you. It doesn't mean that I want my money back in 2 years or 3 years or 10 years. That's not the point. The point is, every day changes my IRR, the internal rate of return. So are you ready to be on that clock? No, you may not be. You may not need VC money. There may be cheaper sources of money available. There's so many companies I meet, even in my own portfolio, when they go through a hard time, somehow they're able to get their customers to pay them earlier to essentially finance their business. But most of us don't think about it. If your customer really likes your product, they will pay you to have your product in advance for the next year, if so be it, because they really want to make sure that you're able to provide that product for you. If those kinds of financing options are available to you, take that. Why would you want, look, you can get, a customer will give you money at 0, interest rate. A bank might give it to you from 5, 10, 20% interest rate. I'm looking at like 30% plus interest rate, at least 15, 20%, right? This is a pretty high interest rate, interest in quotes, it's a return rate that I'm looking for. So it's more expensive money. You should take that more expensive money if it is able to grow and really pour fuel on the fire. The second part of the question sounded more like take major ownership of the company. Look, if major is absolutely, I take major ownership, 15, 20%, maybe 25% of the company when I invest, and then I maintain that ownership if I can and invest a lot of money over time. But if you're talking also about like majority ownership, where people are like sort of being sharks and, hey, here's $1 million and I'll take 45% of the company, or here's 2 million and I'll take 51% because I don't know you and I have to own majority. I think you've then changed the dynamic completely. This is no longer a bet on an entrepreneur and a founder building something. You've changed that to where I'm running the company and you work for me. And there's a reason why professional US VCs never do that. Unless they start the business, unless they are the founders of the company, they don't put themselves in that situation. I want to invest in founders. I don't want founders to work for me. On maintaining relationships, when you say no to a company when you've invested in, and companies that shut down that you've invested in. Look, I would say probably less so for Lux Capital because of the kind of companies we invest in, but across the board, you would probably think 50, 60% of the companies we invest in would be effectively shutting down, right? They just won't make it. They will spend the money and they won't get enough traction. And maybe nobody even wants to buy them, or there's too much burden on them to really for somebody to be attracted to buying them. They shut down. A few things that come there. I go in knowing that that's the possibility. I'm not going to tell you that it is easy. I'm not going to tell you that I take that lying down and didn't work. Oh well, let's just move on. No, I mean there's a certain expectation that the founders are going to put their life and blood into this. They're going to put everything into this. I always say, I can only sleep when I know that the founders that I've invested in are freaking paranoid. If they are awake at night working on the problem, I can sleep, right? But it is a completely different animal where I feel like the founders are just going off the reservation. Either they give up too soon that, hey, I thought this was going to be $1 billion company. Now it's not. So yeah, fuck it. I'm just going to move on. Then that's when relationships really break apart. The second thing that happens when relationships fall apart is where founders don't realize that not only am I a professional investor, which means that you've now taken money not from your uncle or grandfather or whatever, you've taken money from a professional investor who's answerable to other people, who's answerable to SEC, who's answerable to New York Times if they call me, that you have to act a certain way. And if you don't do that, you are essentially not only putting your own reputation at risk, you're putting my reputation and my LP's reputation at risk. And that's a lot of people that are really important. Their public opinion really matters, that are now exposed to that. So there is zero tolerance for me for people that do anything illegal, that do anything shady. It's just not worth it. I could have invested $10 million into your company and I will write it down to 0 and I'll walk right out of that door. Now, before doing that, I will put up a fight to make sure that on behalf of all my LPs, I'm playing the fiduciary role. But I am not going to stand behind you and support you if you're doing something wrong. And that does happen more often than you would think it does. It could be on the financial front. It could be on the behavior towards other employees front. It could be a behavior towards, other founders. It could be a behavior towards other investors, all kinds of things. Now, last but not the least, and this is really important because I went down one path. The second path is VCs have to have a real perspective of The loss that I might be feeling if I lose $1 million or $10 million is just a financial loss. The founder has probably put their entire life into this. You know, they are losing a lot more. I mean, money is fungible, right? Like all of us have had people who've gone to the hospitals and they've been admitted into ICUs and you're spending a ton of money on a daily basis. And then some make it back and some don't. Regardless, do you ever stop to think that I shouldn't have spent that money on that hospital? What you think about is what that patient went through and what that family went through, right? They may not even be spending the money. It may be a rich family member or, you know, whole family contributing towards it together. But the feeling is all about the people. And that is something that, you know, good VCs really have to understand, that you've put in 2, 3, 5, maybe 10 years of your life. You've put in everything you had into this. There were times that, you know, your children's birthday and you were at work. Your wife is upset with you, but you're on a call, right? You could not sleep all night because the code isn't working or a customer just said no that you were expecting to close for the quarter, right? You've gone through that again and again and again, and having empathy for that is extremely important, because this goes back to people will choose me to be an investor in them because they know I'm not an asshole. I'll be honest, I'll be blunt, I'll be there, you know, in very crisp way telling you what works and what doesn't work, but I will understand the humanity that comes in with all of it. You know, VCs are humans, entrepreneurs are humans. Bill Gates puts on his pants one leg at a time, just like you and I would. There's nothing different about us, right? All of us have the same thing. If Bill Gates' child gets sick, he probably worries the same way that I worry when my child gets sick, and the same way that a lowly person who might be a janitor in your company worries about their child when they get sick, right? Having that level of empathy about this whole thing is really, really important. And when you lose that, and when people can't see that empathy, they start disassociating with you. This is what happened when people look at Jeff Bezos today, or they think at Bill Gates, or they think about Mark Zuckerberg. The reason people start to think that they're like robots all about the money is because they can't really relate to their family lives, and they can't really relate to the humanity in them. Like, you think Jeff Bezos cares at all about the money he makes anymore? Not at all. That's not about it. He's not doing this to make another $1 billion. He makes like $30 billion a day when stock market goes up. Right? There's no company you can bring to him that can make him any richer. Right? He is doing it for a different reason. And I think understanding that human, you know, factors associated with our work is really, really important. Okay. I don't know how much time we have, but I'll try to go through this quickly.
Yeah, we'll probably want to stop at, I don't know if you have a hard stop, Bilal, but maybe around in like the next 5 minutes. So
great.
Yeah.
I'll go through these, a few of them here. Does taking money put undue pressure on a company to go more quickly than perhaps the situation allows? Absolutely yes, in both ways. Sometimes you have too much money, so you feel the pressure to spend it so that you can show that, you know, not in a bad way, but spend it to show that you're taking more chances or doing more things. You start taking more risk than you otherwise would. Sometimes it's justified and sometimes it's not. But the second thing is also that, you know, understanding your business and its metrics are really important. And sometimes you can get caught up in the wrong metric and you start to optimize for that, and then everything falls apart on the other side. So you have to really have a good understanding on your business. Why you see some founders so focused on SaaS metrics, for example, is because it gives them a very good understanding of the business, that if I press this button, what changes and what moves. What has made the biggest difference in your successful investment? What recent deal do you like most? The biggest difference has been people, undoubtedly. Like a founder that wouldn't give up and almost like came back to life and built a company, just wouldn't give up. You know, even when I was on the verge of giving up, he or she just wouldn't. At the same time, a founder that just scales. You know, a company, as I mentioned again, I'm looking for companies that could be worth billions of dollars. Every single company almost that has become worth $1 billion or more has had to reinvent itself at least 3-4 times along the way. Okay, I mean, just look at Facebook. It has to completely reinvent itself. And the classic example everybody uses is Apple. You know, they just threw out old products, built out new products, even though the old products were selling. And they had to do that because they believed in the future. And good founders have the capacity to do that. So one more thing, going back to the earlier question around founders, is when I'm evaluating founders, it's not just, oh, you said you're going to build a pizza distribution company in Pakistan. Do you understand pizza or do you understand distribution? No. Who knows? Maybe tomorrow pizza distribution will go away and you will become, some sort of a bank that's basically funding, distributed pizza makers all around the country. Can you invent yourself to be that? Because that may emerge as a great opportunity while you're doing that. Look at Stripe. Stripe was an API for payments. I was a general catalyst when we invested in the company in the Series B. It was an API for payments. Is that what it's doing now? It is an anti-fraud company. It is a money forwarding company. It is a credit card company, all of the above. It is not just an API. Now there's many other places you can use for it. At that time, there weren't anybody, but now you have lots of APIs you can use to process payments. Stripe had to invent itself many times over, which is why they're worth whatever they're worth now. How do we develop more female founders, especially in Pakistan? I talk about this a little bit. Male founders in Pakistan have probably less in common with male founders in the US because you're solving different problems. Some of the problems may be similar, but some of the problems have to do with, the bureaucracy, the corruption, and other things that are very real for Pakistani entrepreneurs in Pakistan than they might be in the US. Female founders in Pakistan probably have a lot more in common with female founders in the US. Because in addition to all those business issues that you're dealing with a systematic bias that's against you. Everything from co-founders treating you a certain way to employees, treating you a certain way to obviously fundraising processes. I tend to believe that, female founders, these are number one, undersell themselves. They don't boast as much. Okay? Male are like, I did this, blah, blah, blah. I started this company, sold for $2 million. And the female founder may have a wonderful business that has been going strong forever. And they could be managing, like my wife, a professional physician, also manages the entire household and everything. And it's a pretty complex household, but she never talks about it as such. I don't manage anything. I just talk off the seat of my pants. Whereas she has to know every dollar and cent, but she never talks about it. Whereas here I am giving a talk like as though I'm going to, change your lives. This is a big difference between males and females, generally speaking, that I think we need to somehow, I educate my daughter, who's 12 years old, all the time to speak up. Why are you focused on the mistakes you're making? Talk about the successes that you're having. But the second other thing I would say is also that female founders tend to build companies with a longer term perspective. I think they're focused on profitability, I would argue more, maybe this US thing, but focus on profitability more than some, vanity metrics or quick escalation and valuation and so on and so forth. I mean, if you look at, CEOs of companies like Stitch Fix and others, I mean, you see that so obviously. So if I was investing in Pakistan, and I'm not going to discriminate male versus female, but I am not today going to Pakistan to invest in a company so that in the next 2 years it becomes a big company and then somebody buys it and then I'm out of it. A quick flip. I'm not going to do that. If I go to invest in Pakistan or Bangladesh, it's because it's a long-term success. There will be ups and downs and I have to be mentally and psychologically prepared for that. Monis Rahman is a friend of mine. When he went to Pakistan way back when, he knew that he was going to invest in Pakistan with himself. It was going to be a very long journey and he's gone through multiple companies and so on and so forth, but he's a long-term, investor in Pakistan. I would go in with that mentality and I think I wouldn't be surprised if I see more female entrepreneurs building things like that. Now I will need them to be more ambitious on the size and the scale of see that. And yet, the two things I'll say there. One, every startup is hard. It doesn't matter what you do. If I told you to open up an Indian restaurant around the corner from where you live, it's going to be bloody hard for you to do, just as hard as it for somebody who's building Snowflake. Like, don't buy that nonsense that somehow, you know, an enterprise software company is hard or a fast scaling consumer startup is hard. A damn pizza restaurant is very hard to build and make it successful. So every startup is hard. So the question that comes back to is, are you doing something that, number one, you're passionate about, but number two, it is going to have the kind of impact that you would like to have, given that no matter what you're doing, it's going to be hard anyways. So if building a distributed databases company or an ML AI infrastructure company just doesn't excite you enough, even though it's a big opportunity, then it's just not the right thing for you, even if it could be worth a lot more. You're just going to be miserable doing it. Remember that 80% of the companies either fail outright or barely return capital to its investors. So most of the time, you're going to be dealing with tough situations, and you don't want to be doing that for something that you don't really care about. So that's really, really important. The second thing I'd say is this is an absolutely incredible time. Everything is up for grabs. It used to be that we would build businesses to sell to the CIO or the COO or the CMO. There were budgets in corporate America, typically in enterprise systems, that we would go after. Even if you were a consumer company, you were really selling ads to companies, right? You weren't selling anything to consumers. That has completely changed. Vast swaths of our GDP are completely getting digitized and digitally transformed. In the last 25 years, the movement of internet, we primarily changed two industries: communication, whether it's email or text or WhatsApp, and information, you know, the newspapers and all, or we changed commerce, right? We can buy things online. But today, everything is up for grabs. Manufacturing is up for grabs. Construction is up for grabs. You know, distribution of medicine and healthcare is totally up for grabs. Think about every aspect: entertainment, community, conversation, government, politics. Everything is getting digitally transformed. It's amazing opportunity to build companies. What happens in these sort of economic recessions and these periods is that, as I said, a large percentage of the people are not going to leave their jobs from large companies because, you know, they're looking for stability and frankly insurance. But the few that leave because they know that the next year or two, while they're building this startup on this amazing idea, every other company is distracted. Microsoft and Google and Amazon are not investing in new ideas right now. Every other big company is sort of, you know, hey, let's get back to the basics. Let's make sure we do what we do well. So your idea, which is a crazy idea, and in good times, you would have had engineers at Google say, you know, hey, I can do that too. Give me a little bit of time. Maybe I can go build this thing. That's not going to happen. You are now a little bit free and have a little bit less of a competition to go build that company that you wanted to build. And hence, 2 years down the road, when the economy comes roaring back, which has happened every single time, you will be ready with a product and a product market fit that nobody else would have had. And we've seen again and again and again, every time a recession happens, why amazing companies get created? Because those entrepreneurs who believe in themselves, who are like, I can always get a job. It's not like I'm not going to get a job. I can get a job. So why don't I just use this time when nobody else is building companies to go build something interesting? That is what got me into entrepreneurship. Post my PhD, I asked myself this question that, yes, it's the first job I've had, you know, should I quit it and start a company? And I said, I can always get a job. This is the time to try something and do something. And it put me on a completely different trajectory. Anyways, I'll stop there.
Yeah, Bilal, thank you so much for the really candid and raw discussion. Really appreciated you walking through all the questions. We have a lot more questions coming through even as you were talking. So there are a bunch more. And if you don't mind, would love to send those to you as a follow-up, if you can just answer them, and then we can share those questions with the community through our Slack channel. And
Absolutely.
That's okay with you.
I'm happy
Perfect.
to do that.
Again, thank you for this wonderful discussion and keeping it so candid, direct, open, and raw, and especially for your time. So everyone, just as a reminder, follow Bilal on Twitter. We want to be very mindful of everyone's times here, so we want to end on time. And then keep contributing to the community. It's an open community. We want everyone to participate and be an active member. So it's not a community, you know, led by one person. It's a collective. And And I don't know how to say a final thank you to Bilal, but I've seen this like trick on a pun competition that I was watching. If whoever has their video on, maybe we can just give Bilal a little wave as a thank you. Okay, perfect.
Thank you, guys.
Thank you so much. Really appreciate everyone's time and for all the fantastic questions. Take care, everyone. Bye.
Thank you so much, Bilal. Thank you for your time.
Bye-bye.